What's up, traders? Anthony Crudele here, and thank you for tuning in to the Futures Radio Show podcast. I appreciate all of you guys being patient with us on that live start. You know, a couple of Italians like Alf and myself, he was actually giving me some pizza recipes, and we were talking about some other fun things as well. But I'm so looking forward to this today. What to expect from the Fed at today's meeting and the impact on the markets following the meeting. Today, I have one of my favorite macro traders on the show, and Alfonso Peccatiello, otherwise known as @Macro Alf on Twitter. And today we're going to dive into preparing for the FOMC meeting, what we think is going to happen potentially after the markets. I'm going to ask Alf what he thinks about inflation, the ECB news. There's just a lot of things to discuss, and we're also going to go to the charts for Alf to show us what he's seeing on the technical side as well. Today's podcast is sponsored by TradeStation and FTSE Russell. Currently, TradeStation is running a promo just for our audience. New users get 50% off brokerage fees for the lifetime of their account. Use the promo code FUTRAFZT as long as you open an account by July 30th. Go to tradestation.com/Anthony to learn more. There's also a link down below. Are you watching the stock market, specifically the Russell 2000? The Russell 2000 is a key benchmark for small cap U.S. stocks. Be sure to check out the E-Mini Russell 2000 future symbol RTY and Micro E-Mini Russell 2000 future symbol M2K. To learn more about FTSE Russell and their products, please visit FTSERussell.com. All right, everybody. Macro Alf is in the house.
Hi, Futures Radio people. Anthony, how you doing, man?
I'm doing great, man. Thank you so much for joining me today. You know, I've learned so much from you on the macro side of things over the past long period of time. And I got to say, I'm really excited to have you here today on really a day where I hate to put any emphasis on any single day, you know, Alf, where a day really is going to set the tone, but there is so much build up to this point. And today I actually want to talk about what the ECB stepped in, and there's some breaking news today. Explain to everybody, first off, what did the ECB do today?
So, Anthony, they basically stepped in to make sure they can hike rates to a decent amount. And that might seem counterintuitive to people. What the heck? They just stepped in to hike rates more? So let's see how that works. And how that works is Italy is basically, together with Greece, Spain, Portugal, it's the weak link of the Eurozone. The Eurozone, Anthony, is a very interesting structure where we have one monetary policy for 19 different countries. And then we have everybody trying to do their own fiscal side, but then we have European fiscal rules as well, bounding them on what they can do. It's a very, very weird structure. And when the structure is challenged, then the weaker parts of the structure tend to suffer the most. And that is what was happening. So the spread between Italian government bonds and more every single day, it's a sign of stress, right? And today they came in and they said, okay, we're having an emergency meeting. And we are going to make sure that the fragmentation risk is not big enough. It's not going to jeopardize our ability to go ahead and high interest rate because we got to fight inflation. And if Italy blows up, then we can't fight inflation because we have another problem on our plate and we don't want that problem. We need to backstop that issue to be able to hike rates. And that's what they did today. They tried to backstop Italian government bond spreads.
What I find so interesting about this time is I look at guys like you who have been way ahead of the curve, but it seems like all these central banks are way behind the curve.
Yeah. And you're right. I mean, I don't know if we can pull up charts so people already see them.
Yeah, let's pull them up right now.
So basically, this chart was published a few weeks ago on one of my pieces on the Macro Compass. It's a free newsletter I write. Everybody can go there, check it out. This chart shows the central bank's reaction function against inflation and inflation expectations. Sounds complicated, guys. It's really not. But this is the basis of macro understanding. You need to get this chart right. On the x-axis, there are inflation and inflation expectations. On the y-axis, there is a central bank reaction function. Can you see the linear part in the middle of the screen? This one, right? So what happens is that if inflation goes 1%, then central banks get scared and they're like, okay, inflation is too low. I don't want to see deflation in a system that is based on that. You really don't want to see deflation. We can talk about why you don't want to see that, but they're scared of this area, right? So if you move from 1.5 to 1%, what they will do is they will ease. You see, there's easing there, and then they will linearly ease, which means they'll cut rates by 25 basis points. They'll do some QE, right? If inflation instead is rising from 1.5 to, let's say, 2.5%, they will be doing the opposite. They will hike rates, but always in a linear fashion. You see those boundaries, Anthony, here, 1 and 3.5%. Here is when they get really, really scared. And when a central banker gets scared of losing credibility, of losing control, of losing the narrative, the status quo narrative that everything is going fine, the reaction function becomes complex. Can you see the line goes up much faster here?
Yes.
Which means here is where we stand now, guys. We have inflation expectation. I'm going to show them to you at 3.5% roughly in the US, but also in Europe. So we are basically here. And on realized inflation, we are at 7%, 8%. We are in a territory where a central banker will try to do his utmost best to bring inflation and inflation expectation in the comfort area. And to do that, they will try and get themselves ahead of the curve. And as Anthony said, they are doing that now, and it's very late. But you gotta respect what they're trying to do now. They're trying to put themselves ahead of the curve, and they won't stop until they get the job done. That's where we are right now.
So here's my question on this, is that when they come this late to the party, what is the repercussions to the market when something like this happens, if they start to come this late and get this aggressive?
Yeah, well, one of the repercussions visible if we go on this chart. Yeah. So this is the yield curve in Europe. Of course, you guys have heard a lot about yield curves in the US, but I'm Italian. Well, my accent probably gave that up already. So I look at this side of the pond too. This is the 5-year versus 30-year curve slope in Europe. And just look at that, Anthony. It's basically inverting in Europe too. And do you know the last time it inverted? It's in 2008. So what's happening is that the bond market needs to respect that central banks will try and hike rates to fight inflation. And that's reflected at the front end of the curve, 2-year, 5-year bonds. The bond yields go up because they need to basically price in what the central banks will do to try and fight inflation. But the back end of the curve, the 3rd-year part of the curve, that's a different story. 3rd-year part of the curve reflects long-term growth, long-term inflation expectations. And those don't go up, Anthony. Don't go up because if you crash the private sector right now, if you come in, you crash the economy, you raise rates to a very, very high level to fight inflation, you will make damage. You will, unfortunately, have to damage the demand side, the private sector. And as we are very levered up, private debt to GDP in America is something like 160%. Private debt, it's us, it's not the government. The government can always somehow print money, but we can't. And as we are very levered up, if the demand is hit very hard, the repercussions are very strong. And you see that 3rd-year yields can manage to go up because they need to price in this long-term damage we will do. And so the curve flattens and it even inverts. And equities sell off, and credit spreads widen, and Bitcoin sells off. And anything that resembles risk sentiment and animal spirits has to slow down. That's what happens.
So where is that middle ground, that risk versus reward? Because I'm seeing some tweets out there from a lot of people. I actually tweeted a couple of them, and these people are saying, guys that have been in the business for a long time. Let's actually get a name to see who I retweeted. I can't even remember. I've seen so many of them the last couple of days. Nonetheless, reputable people that have been around a long time that are saying, just do 200 basis points tomorrow, or 300 basis points, or even 400 basis points. And I look at that and say, I mean, that sounds great from maybe your perspective, but where is that middle ground, Alf, to where the risk reward makes sense, so we don't actually overdo something to cause more damage that becomes irreparable, like you talked about?
So the middle ground is reflected in this. Again, sounds complicated. It's bond market magic, but I can try to sum it up for you guys. So this is the terminal rate, which is nothing else than the highest point in the hiking cycle that the Federal Reserve can reach with their federal funds rate as priced by the bond market. The bond market will say, what's the probability you do 50, 75, 100 basis points tonight? But then the bond market will be like, okay, but then you have a meeting after that, and a meeting after that, right? So via these Euro-dollar futures and the Fed funds future, we will be able to price in what the Federal Reserve will do, or the market expectations for what the Federal Reserve will do over the next few years. What I took there is the highest point, which is priced in as the highest Fed funds rate over the cycle. And now see that it's gone all the way up to 4%. Right? So what is the midpoint? The midpoint tonight, for if you ask Powell, what will make his dream scenario? His dream scenario will be that he comes up, he hikes by 75 basis points, because at this point, Anthony, it's been fully priced in by the markets. It's been leaked by the Wall Street Journal. He doesn't have much of a choice. Anything that is dovish versus expectations will make the bond market rally, the equity market rally, credit spreads tighten, even Bitcoin rally. And if you're the Federal Reserve now and you want to slow down the economy, because that's what they really want, they want to slow down the economy so that the inflation slows down, you cannot have equities going up or credit spreads going up. You need to price yourself against expectations. So let's say 75 basis points. But that is not the most important thing tonight. The most important thing tonight is, will Powell endorse this terminal rate or not? Will he say we are ready to go higher than this? Or we don't want to go there because you guys are nuts. If we go to 4%, we implode the economy. We don't want that. So it's this balancing act between having to seem very aggressive on inflation because he needs to be so. Remember the first chart I showed, he needs to put things in the control area back again. But at the same time, if he's too aggressive, the bond yields are reflected on our borrowing costs, guys. That's what you need to get your head around. If a treasury yield is 4%, you are borrowing at 6 or 7% because you're not the government, you have a credit risk. When you go and ask for a mortgage today, you got to pay 6.5%. 6.5%. And that is double what you needed to pay a year ago. And you're like, yeah, but it's still low as a mortgage rate. When I was 20, that was 14%. Yes, but when you were 20, the house price was less than half what it is today. Less than half. And so the affordability, basically, of taking new credit in as private individuals becomes worse and worse. And so we cannot afford to keep up with the prices. And so if credit becomes expensive to the point we cannot afford levering up our business, we cannot refinance, we cannot get credit to buy a new house, what will happen, Anthony, is that we pare back spending. We don't hire anymore. We cut people. We slow down the economy. That's what the Fed wants, but they need to be very careful. If they do too much of that in an economy which is so dependent on debt, on leverage, they risk that, stuff gets out of control and we get a proper recession. And I wouldn't want to be in Powell's shoes right now. That gentle tightening exercise, it's so difficult to achieve.
So a couple things I want to ask. So I think that consensus at this point now, as you said, from the Wall Street Journal, they had Steve Leisman out there saying 75 basis points yesterday. So I think that is consensus now. That happens today. Let's just say that that's what does happen, because I want to go over a couple scenarios actually with you. What are you looking for? I heard everything you just said there from him to say. Following that, what is some of the verbiage you'd be looking for to provide comfort to the market, to say that you would think, even though they've been a little bit behind, that they've caught up, but they're not overshooting? What would be that perfect kind of verbiage?
Okay, so the verbiage that the market rally, obviously if he hikes 50 basis points, that's already a strong signal today because he's undershooting compared to market expectations. So for traders out there listening to us, how the bond market works, it's not an absolute machine, it's a relative weighting machine. So the market consensus right now is around 75 basis points. If he hikes by 50, he did less than what's priced in, which means that bond market rallies and it drags with you as well all the other asset classes, credit spreads, equities, any risk asset will tend to rally. The dollar would sell off. You would have a typical risk on rally spurred by the fact that it has delivered less than priced in. So not absolute, but relative against what's priced in. That's how bond traders, I used to run a 20 billion book until a few months ago. That's how we do it. It's against what's priced in. The other thing, so that would be a big dovish surprise, obviously. The other thing that is a dovish surprise, and it's more subtle, but more important long-term, guys, is, okay, the terminal rate the market is pricing in is 4%. Powell told us that the neutral interest rate at which the American economy doesn't slow down, doesn't accelerate, it's just a rate at which the economy can run smooth, That rate, according to the Fed, is 2.4% in nominal terms. The market is pricing in a terminal rate at 4%. So it's pricing it that the Federal Reserve has to hike much above neutral rates to slow things down enough for inflation to slow down. He needs to tell us, Anthony, does he agree with that or not? Has he moved this estimate of neutral rate higher? So maybe the American economy can take more because it's stronger than he thought it was. Or does he agree with the market that that is the stance necessary above neutral rate to cool things down? And this will be so important. So watch for words around where is neutral rate? Have they changed their assessment? Is it 2.4 or is it now 3%? Which means they feel confident they can hike to 3 and nothing is going to happen. And because inflation is so high, they probably need to hike to 4 or 5% to bring it down. Or have they left it unchanged at 2.4? That's already one important thing for you to understand how they position. The second is how much above neutral do they have to hike? So watch for his stance of above neutral. How tight do they need to become? Because the market is now saying it's 160 basis points above neutral, from 2.4 to 4%, which is priced in back there. So the amount of tightness and where is the bar? What is neutral and how tight do I need to be against what the market is pricing in? That's what you need to care about. Watch that verbiage, and not only the 50 or 75 basis point hike. There are so many more nuances. The third thing, sorry, and then I'm going to stop. QT. So the guys
What was that? I
basically,
missed it. What did you say? I think I missed it.
the third thing, and then I'm going to stop, is quantitative tightening.
Got it.
And so on quantitative tightening, the guys told us there is a certain pace is set, the runoff, blah, blah, blah. But they still can make tweaks. For instance, they can suggest that they can sell outright some mortgage-backed securities from the balance sheet. They can suggest that they can sell some treasuries long-end treasuries, and they can buy some short-end treasuries. So they can make the curve steeper, for example. Watch if they say something more on quantitative tightening, because that can also move the markets very much one way or another.
It's a lot to take in. I think from the trader's perspective, I've actually seen a lot of questions starting to come in. I look at it like this, is that today really is actually a very important time. And like I said at the beginning, I hate to put too much emphasis on one specific day, but because we only have really the July meeting, and when's the next one after that? I think it's end of September, right? So we basically have, I think what they do today, and obviously sets up what they potentially do for July, is going to really set the tone for a period of time. And when I look at all of this, I look at it and say, based off of today, now I actually want to talk to you a little bit about your positioning. I know that you've been short the S&P. I remember when you put that call out a while back. First of all, are you still in that short?
Yeah, I am.
You are.
Yeah, I started it when I was 4,400, I think. 43.85 was my entry on the E-Mini.
Yeah, I remember.
Started targeting 4,000, went there. Then I just moved my targets. We can talk about how I manage risks as well, in case you want to talk about it. But go ahead. Sorry for interrupting you.
I do. No, I do want to get to that, because it makes me look at, like, the next thing I'm thinking about is, from what happens today, how do people, this is going to be a major repositioning type day, I would think, because I don't care who you are. It's almost impossible to predict exactly what comes out of today. So you're going to see a lot of repositioning.
That's right.
And I think looking at it from someone like you who's been on the short side for a period of time, I'm curious what in your mind, talk about it from the trading side now, where you start to say, I need to rethink my positioning because maybe they did as far behind as they've been. Maybe they've now caught up. Maybe this changes things to the short side. What would trigger that?
So I get thrown under a bus if they come up and they do not endorse the bond market pricing. If they say, look, guys, you've gone too much ahead of yourself. We're not going to do rates at 4%. Give me a break. And if they come up with that, then the stock market will rally so much. I mean, this can generate a rally of 10% plus in a few days.
Because it's like a rate cut, basically. I mean, it's less of a rate
Exactly.
hike, but that's exactly what it's like. I get it. Yep.
It is basically a rate cut against expectations. And also,
Yes.
even worse, if they say 4% terminal rate, we're never going to get there. Get the fuck out. Sorry for the French. And then in that case, it's even stronger because it's not only the front end that rallies, but it's also the 5-year, the 10-year, all the duration intensive stocks, all the NASDAQ stuff, all the S&P, Bitcoins of this world. They will have their discounting factor for future cash flows. Instead of 4%, they'll have it 3%. Now, obviously, you have to change the net present value of these cash flows over time, which will push stocks up. It's just a mechanical thing. And I can get my face ripped off if that happens.
You know what's
What are the
interesting about this? Oh, go ahead. I'm sorry. I don't want to interrupt you. I apologize.
No, sorry. I was about to say the reason why I am still short is twofold. The first is I do not think that Powell can afford surprising so much on the dovish side because he still has a big inflation problem. And we can cover how big that is because people have to look under the hood. And it's not like the headline inflation rate, the year-on-year inflation rate. That gives you a very partial picture of the situation. If you dig a bit deeper, I have some charts, you'll see that the inflation momentum isn't slowing down. The composition of inflation is becoming broader. It's very scary for Powell. I don't think he can come up and surprise very much dovishly. That's my first discretionary macro take. The second is that I have a risk control mechanism where I enter the trade and then I set a stop immediately, straight away. I never enter a trade without a stop. It's just not a thing for me. And then I know I have to know exactly how much am I going to lose before I enter a trade. And then I put the first profit target. And if it's working my way, like with the S&P, then what I do is I move the profit target higher in P&L terms, and then I take the stop and I move it in a trading fashion higher as well. Just create a channel, basically. Like if it moves my way, I just keep on moving the two things. And that's what's been happening, right? So I have a set stop tonight, which basically gets me out of my position if I've been proven wrong. And getting me out of my position means that I'll be making money still because I'm lucky enough that it worked my way. So this systematic approach to risk management that allows me to not be emotional about the trade, to take a step back and say, I'll assess the probabilities tonight, what's going to happen, X or Y. Okay, I still want to keep short in the position. If I'm wrong, then my systematic stop loss, which is a profit target by now, I mean, makes money for me, but still, that stop will be hit. No questions asked, no if, no moving the stop, no nothing, because managing money, I learned, you shouldn't do that. You should be religious about how you manage your risks. But sorry, I went too long. What were you about to say?
No, I mean, that's great. I'm glad that you mentioned that because when we get to the other charts and things that you're explaining, people understand your process. And that's one of the things I really enjoy about, reading your letters, that you explain your process. It's not just macro, it's about process. It's about taking it to actionable situations. A couple of things that I get from you today is number one, it could also be price that gets you out because you have the stop. So the market could do something that, we're not prepared for. And even though you could do all the homework you want, you could still potentially get you out of that position, which is, what traders have to do no matter what. And the other thing I just want to talk about, I think just for a quick second, is just this is why I think you're so helpful to myself and many others. I'm seeing a lot of comments about that, is that I never really looked at it this way. It's crazy, but you were talking about how to watch the market will react. Not just based upon consensus, but going back to what market expectations are, and to almost look at that as a rate hike. Are they hiking enough? Where are they to where you talked about with neutral? And if And like we even talked about, like where you said you could possibly get run over, it almost feels like a rate cut because it's not keeping up
Yeah.
with what that is. And that really, for someone like me, Alf, I don't know what you know. I admit that. I'm a trader out there who likes to read this stuff, and I try to take it in as simple as possible. And to me, you really helped me simplify that. So I really appreciate that. I think
And
that's extremely important for any trader because we don't want to have too much in our head. I'm already a confused person now. If I can't handle too much.
Anthony, look, this business is a never-ending learning journey. So I've been
Yes.
lucky enough that I've run a large amount of money and been exposed to policymakers, central bankers, the smartest hedge funds out there. My mentor was a fantastic guy, but I never stop learning, and I have to challenge myself every day. And I learn so much from traders, more active traders than I am, because I can do a couple of things in macro, but it never stops. It never stops, and the market humbles every single time. So we are here together. If I can share some knowledge with you guys, I'm super happy to do so. Bombard me with questions. And by the way, I'll be wrong plenty of times. Now we're talking about the S&P trade. In February, I was short crude oil. Want to try that? Short crude oil this year is a great position to have. Huh? So the reading was wrong, but yeah, I just stop out. I have a set stop out. I lose X% of my assets under management. That's it. Next play. I mean, you gotta be honest with yourself. You'll never be right 100% of the times. It's all about probabilities, managing risks, connecting the dots. And if I can help you guys with that, here I am.
Yeah, no, we appreciate that. And we're going to take a 15-second break, everybody. When we come back, we're going to talk more about inflation with Alf. We're going to talk to him about crude oil because that's going to be, I think, something that we have to obviously keep an eye on going later. And I want to pick your brain about gold. If it doesn't work now, when's it going to work? We're going to grab a sip of water. Back in 15 seconds with more charts from Alf. All right, quick sip of water and we are back. So, Alf, I named those things that we wanted to discuss. You tell me where you want to start. You want to go maybe to oil, gold? You want to talk more about inflation? What do you think?
I wanted to talk about it. I need to, I think, give some perspective to
Okay.
our audience. So let's talk about this first for a second. So you guys read a lot of headline inflation, 8%, 9%, 10%, right? Cool. If you're a central banker, what you care about right now is how sticky will these inflationary pressures be? What's creating this inflation? Is it going to stay with us or is it going to fade away? So this chart here shows you the contribution to total CPI. So the CPI is, 8%. If you sum up all these numbers, you'll reach 8%. But it gives you an idea as well of the momentum of each contribution. You see the downward line? That's used cars and trucks amongst the most volatile components of inflation. You see how it's going up, down, up, down. You see this green line, it's all over the place. Yeah. And that's the only thing that is going down now, contributing to CPI. All the rest is going up. And now let's pay attention. You see the blue line, that's energy. Well, of course, we know. We go to the pump and you know that energy is going up. You understand that. Okay, cool. And central banks can't really do much about that straight away. They can't make Russia and Ukraine stop the war. It's not in the power of the central bank. But now let's look at the red and the white line. So the red line is shelter. And shelter, as you can see from the time series, look at that. Look at how sticky and stable this red line is. And it went down during pandemic. Look at how up it went. Rent of shelter is one of the stickiest part of the inflationary basket, and it's been going up, up, and up again. And look at the white line. The white line is basically core inflation, all the other core prices, right? And look at where it is. I mean, it's by far the highest contribution to inflation we have right now, and that is core. That is the core, the sticky stuff. Another way to look at this is core services against core goods. And you can really see the two sides of the inflationary pressures, the pandemic one and the post-pandemic one. And the pandemic one is the white. core goods. Core goods prices went up all the way to 12% year on year at some point. And why? Because the government said, Anthony Alf, I'm going to give you a bunch of money, all right? I'm going to send you checks home and you have some fun, see what you can do. And you're like, dude, I can't do anything. I'm locked home. Oh, let's buy some goods on Alibaba, Amazon, and all that stuff, right? That's basically what we all did, let's be honest. And core goods went through the roof also because the supply of these goods was impaired. All the factories were closed. That's what happened. And core services back then. So services are the sticky part of the inflationary basket. You need an open economy for services to flow and services prices to go up. And they went down. And now look what's happening. Core goods are coming down a bit, but core services are at a year-on-year pace. Core services prices. Look at where I need to go on this chart. I need to go back to the 1990s to find core services going up so fast, 5% year on year. What I'm trying to point out is that inflationary pressures are broadening. It's not only goods, it's not only used trucks, it's not only cars, it's now core services, it's rents, it's the sticky prices. Those are going up, and that is scary. And it is reflected in inflation expectations, Anthony. This is us, bond traders, going there and telling markets and the Fed, where do we think inflation is going to print on average over the next 5 years? 5 years is quite a long period of time. If you're a central bank, you're like, 5 years ahead of me. Let's see what the average is. Reminder, the inflation target is 2%. The chart says 3.5%. Over the next 5 years on average, Anthony, traders expect inflation to print at 3.5%. It's a message to the Fed. It's like, guys, we don't believe you anymore. We don't believe you. You got to do some work here to bring us back in this chart again. Now it's time to bring it over again. Here is the 3.5 where we are. Remember this chart? Not only spot inflation is here, but inflation expectations for the next 5 years are here in the danger area. And then central banks have to come in. They have to show that they're serious about it, or otherwise things won't heal. The reaction, of course, is that if central bankers become more proactive, they show their willingness to tighten conditions, what happens? All companies that thrived in an environment where interest rates were so low, they could borrow at such cheap rates, Anthony. They could refinance their business so cheap. They could hire people because their leverage was so cheap. Yeah, now I'm sorry, but the leverage isn't cheap anymore because we need to slow things down. We need to bring this inflation down. And so credit spreads. This is 5-year investment grade credit spreads in the US. So those are good companies. Those are not junk rated stuff. We're talking about good companies, decently rated companies. And this is the spread that they pay on top of the treasury yields to borrow, right? Because they have a certain credit risk, they can always default. So investors will ask for a credit spread on top. And look at that. Look at this. 2020, 2021, they basically paid nothing. They paid 40 basis points over treasuries. Nothing. Look at 2017 here, 40 basis points. 2019, 50 basis points. It was so good. Apart from this spike, do you remember this spike? This is December 2018. And then Powell in back here at 100 basis points. You remember that? Powell pivot.
I do remember the Powell pivot.
I'm sorry, guys. I'm sorry if I said the hike all the way to 3%. I'm sorry. I'm going to take it back and don't worry. And then, of course, the market rallied. Equities, credits, anything rallied in 2019. Now, this is a chart from a week ago, but now this is at 100 basis points again. And the difference compared to 2018 is that this time, Powell can't show up and say, oh, no, guys, don't worry. It's all fine. I'm not going to hike. And why he can't? It's because of this. Because this is 3.5%. And the time series of this in 2018, I'm sorry if I didn't put it. This line was 1.9% in 2018. So you can understand if you're Powell, you're like, inflation expectations are okay. Nobody's panicking. The market is panicking though. So I can sort of help out these guys and I can pivot back before it goes worse. Nowadays, it do that. That is the material difference between today and the end of 2018, which makes things so much more volatile, so much more complicated today. It's a very tough environment out there.
By watching this, Couple questions I have about this. One is, it sounds to me as though even if the Fed just nails this and does this perfectly, inflation really isn't going to come down that much in terms of the consumer side of things. Am I
Extremely
wrong on
good
this?
question. This is a super good question. So let's go back and see what's driving inflation. The orange line and the blue line, Anthony, the Fed can do absolutely nothing about those. Nothing. Because, how will the Fed slow down energy? The only thing they can do is to make us unemployed, literally, so we can't drive anymore.
So, yeah, so you're not buying it.
Nah, I mean, food, then it's even worse, but I don't want to go there. But it goes to say how inelastic the food and energy demand is. You really need to get to such levels where the Fed won't hope to have to go to bring these components down. So what they hope to do is to bring everything else down so much that it offsets at least partially this food and energy inflation. Because see it from that perspective, Anthony, they can't just sit out and watch this. They don't have the luxury anymore to watch it out. They need to intervene. And while they cannot move the food and the energy part, they can try and do more on the remaining part of the demand side, of the private sector, animal spirit side. They want me to say, okay, was I planning to expand my business? Did I need leverage for that? I probably need to refinance some of my existing loans. I go to the bank, and the bank is like, Alf, I'm sorry, I used to give you a loan at 5%, but it's now going to be 9%. I'm like, holy crap. Sorry, but I can't afford it. Well, then I'm going to fire a few guys. That's literally what they're after, literally. They're after a cooling down of the labor market, not a disaster. Nobody wants a disaster, but they want to cool things down. And they need to cool it big times to offset the food and energy inflation we're seeing there, Anthony.
Yeah, I mean, this is opening my eyes to saying that this problem is just, even if they nail it, it's not going away. And I just, in my mind, I'm thinking about all these different things and how it's going to impact real estate, food, energy. Obviously stock market prices as a trader, but as a person, I think that this is just a problem that they just can't fix. And I think I want to go to energy next because I think it kind of sets up to what we're talking about here. I see so many people really with this discussion, this battle between why is really crude so high. I mean, everyone will, a lot of people will say it's the Ukraine and Russia. That's the biggest reason, or they'll say the U.S. is just basically just trying to go green, and they're not allowing, you know, drilling as much. And what is ultimately, do you see the biggest contribution and reasons why we're seeing such massive price hikes in crude oil?
So it would be myopic not to admit that the Russia-Ukraine situation is worsening the picture for the oil supply. Basically, a lot of millions of barrels have been taken away from the equation. Effectively, despite Russia and Ukraine not being very big on GDP terms, Anthony, what they are very big at is the energy and commodity production and exports in percentage in the world. We're talking double digits, 10 to 12%, and some commodities all the way up to 40% of GDP, of global exports of that single commodity. So it goes to say they're very big in certain areas, energy included. If you take that supply offline, basically because of sanctions, you're going to make that supply scarcer, and ceteris paribus, with an unchanged demand, then prices go up. But on top of that, there is a mechanism of capital allocation to energy which is impaired. Because of ESG, because of net zero emissions, it is basically impossible for an institutional investor to go and buy oil producers, other companies involved in oil and gas. I was running a $20 billion book for a large European bank. So I know, I've been in these managerial discussions. You literally cannot, Anthony. There is no good price, no good yield, no good free cash flow yield, nothing at which you can just justify to your shareholders that you are going to buy an oil and gas project. You're going to finance those. You can't. And so when capital is so scarce, because of regulatory impositions / ESG impositions, obviously the marginal price to produce an additional barrel of oil goes up, becomes more expensive, and that needs to be reflected in the price, especially if demand is unchanged or going up over time, because we will need to use more oil. We do need to use more oil until we're able to transition to the green area, let's say, to make the green transition. And the Russia compounds the problem on top of it. That's where we are.
Yeah, I mean, it's a combination of everything. I mean, that's kind of what I kind of thought about. When you look at it from me from a neutral standpoint, just looking around, I'm like, this is another situation to where this isn't going to get fixed easily, right? I mean, you can't get that price down because of what you said. It's like there's multiple reasons why this is happening. It's not just one thing that they can do. So I guess it takes me I don't know if there's anything you want to show us on energy. What is your outlook on energy, I guess, based upon maybe what happens today? We'll go back to the charts.
I wanted to show you one chart, if I can find it. So I don't think I have.
And then everybody, I know you guys have been putting in a lot of questions. Don't worry, I'll get them to Alf for sure. I just want to go over some of these things and maybe see if he covers them so we're not getting ahead of it. And we will probably going to go to gold next.
Yes, I just wanted to cover equities for a second, but I need a chart for that. And I can't find. I'm sorry, guys. Let's see if I can. Yes, I found it. All right. Okay. So let's talk about equities for a second. We talked about the bond market. We talked about what's priced in and that it works as the lever against expectations. We talked about inversions of yield curves, Europe, whatever, oil, equities. Alf, equities are cheap because I look at the price earnings and the forward price earnings on the NASDAQ is below whatever average, and that makes it cheap. No. Guys, asset classes do not live in a silo where you as an investor have always the choice to keep your money in a bank account, to buy treasury bonds, or to buy something out there in the risk curve, corporate bond, equities. You always have a choice. It's not equities or nothing. It's equities against your alternative. So what I did in this chart is I plotted my measure of equity risk premium, one of the many I use. If you go on the macro compass, you'll see how it's built, what other measures I use. They're very decent indicators of future performance in different asset classes. So this one will be the 12-month forward earnings yield. So it's the inverse of PE, basically. It's the yield, if you treat your equities as a bond, basically, what will be the implied yield you will make by investing at a stock at these valuations. 12-month forward earnings yield minus real interest rates in America. So what I do is, Anthony, my alternative is to buy some treasuries, right? I just go there, I buy some treasuries. They're the liabilities of the government, pretty safe. They'll pay me back in dollars. And I look at the real interest rate that I can make, real return that I can make by investing in these bonds. So if I buy at 3% and inflation expectation 2.5% over the next 10 years, then I'll make 0.5%. It's not much, but at least I'll get my money back. And if inflation expectations were right, I'll roughly even out, right? That is my starting point. It's my risk-free opportunity to invest at any point in time. It's a treasury bond. It's liquid. It's risk-free. Liability of the government. Great. Then I compare how attractive are equities against this instrument. So it's a relative equity risk premium measure. This is the chart. And as you can see, this is a 15-year chart. So it's not tomorrow. It went through all kinds of environments, great financial crisis, and then QE1, and then the rally, taper tantrum, and QE2, and then whatever, COVID. There is everything in this chart. Basically, the average was around 5%. An investor that is rewarded 5% to own equities compared to own treasuries, it's an average equity risk premium because you're taking a risk. Companies can default. It's more illiquid. It's much more volatile. So there is a lot more volatility you need to stomach to be able to harvest this risk premium. 5% of the last 15 years has been the average. Do you know where we are today? 5%. 5.5% actually last time I updated this chart. It's not like we are at 8% or at 9%. And why? Because equities have sold off, valuations have repriced. So this earnings yield here has gone up. But treasury yields, guys, have gone up too. Your risk-free alternative has become all of a sudden much more attractive than before. So you should measure the equity valuation against your risk-free alternative, which is treasuries. You put them in a chart, and you see that in COVID time, they really were cheap. The cheap and expensive line are 1.5 standard deviation away from mean. So a meaningful move away from the long-term mean. Okay. Here was cheap. Hey, look at this. After the great financial crisis, everybody was freaking scared of equities for a couple of years. Nobody wanted them. That was cheap. This was expensive. This is basically 2019. That's before the pandemic. There was no volatility. There was no equity risk premium. Everybody was buying. Everybody was selling the VIX. You remember that time? This was a cool time. That was very expensive. Before the great financial crisis, this was very expensive. This is 2005 here. Yeah. But right now, this is not cheap, guys. I'm sorry, but this is not cheap yet. So I want you to understand why I do have a bearish S&P position on, because from a big picture macro perspective, this is not cheap. You should look at equities against your risk-free alternative. That's what to cover.
And when I look at that chart, every time it's gone expensive, eventually it's gone cheap before it's gone expensive again, right? So to expect something different, it hasn't gotten to cheap yet. I mean, so when I look at that, I say it's got to get to the cheap part first before it does get back to getting down towards expensive. So I understand what you mean by having the bearish outlook on that. Thank you for sharing this chart.
It's my pleasure. And then I think I need to cover gold for a minute before we go to the questions.
Yeah, well, let's go to gold, because I know some of the questions I'm sure are going to be out of it. And my thoughts are this, I've actually stopped trading gold the past several months because it's just been, it's not working. And I just don't want to keep just contributing money to the market, Alf. At some point, you got to turn the spigot off, man. I mean,
So, don't tell me. I know.
It's tough. What in this environment, to me, I look at it and say, if it doesn't work now, why ever have it? I mean, that's just kind of my thinking. I'm probably wrong on this, but I don't know. What do you think about it?
Okay. Gold. Let me see if I have a chart on that. I have a chart for everything. I must have a chart on gold too. Yeah, here we go. It's not a chart on gold, but bear with me for a second, okay? So tactically, let's talk about gold tactically. Gold is basically... Actually, let's put it like that. Gold is priced in dollars. Okay, so when you're trading gold against dollars. That's what you're doing. And dollars are rewarded a return, a risk-free return. It's the treasury return, right? You can invest your dollars in treasuries as you can get a return out of it, right? So what gold does is it looks at the marginal return you can make on treasuries in inflation-adjusted basis, because gold is basically, you can't inflate it away. You can't print any new gold. So it's a real asset. And if the marginal return on your alternative, which is dollars, remember gold is priced in dollars. If your marginal return on dollars goes up, then gold attractiveness goes down materially, right? Because you more gold on a marginal basis. If with dollars you are rewarded more, I guess you're following me, right? And vice versa. And that's why gold is so correlated with real rates, because real rates are the reward you get by owning dollars on a marginal basis, right? I mean, how much do I own? How much do I get in real terms by buying dollars? And look at this. So this is a 15-year distribution of 3-month moves in real yields. So I took every single 3-month period over the last 15 years in real interest rates, every 3-month move from 0.1 to 4, 0.2 to 0.5, 0.3 to 0.6 over the last 15 years, and I ranked them in the distribution. We are here, as the chart says. So over the last 3 months, we have seen the fastest ever move up in real interest rates in America, which means that on a marginal basis, this owning dollars has become so much more attractive than it was 3 months ago or 6 months ago. Yet, can you tell me what is the performance of gold year to date? Bit down. What is this? 3% down, something like that, right? I don't have it in front of me right now, but
I'm actually pulling up to see what it is. I don't know what it is year to date.
Please tell me, because it's cool. I think. And by looking at this chart, you would think it's down 20%.
Yeah, it's down very. I mean, I'm looking at it from year to date, and it's
Yeah.
down very minimal. Pretty much right, almost
Yeah.
right where actually right where we opened. When I look at
All
the
right. So
futures, yeah,
huge. If you ask me, this is huge. And this is the reason why I went short gold at the beginning of the year, because I thought, real yields going up. I use gold as a proxy, I'm going to make money. And it went freaking nowhere. I'm like, what the heck is going on? Real yields are selling off. I should be making money here.
yeah,
And when you are not able to explain what's going on, one of the first rule my mentor taught me, Alf, get the fuck out. I'm sorry for the
that's it.
French again, but
Yeah,
if you
get
don't
flat, man.
understand what's going on, gold has been so resilient to what's going on in the world. And of course, the Russia-Ukraine story, the weaponization of dollar reserves against Russia, some reallocation to gold, it can explain some. But guys, the resilience has been huge. It's been massive. I'm very impressed by gold year today. It should be down 10 to 12% minimum, and it's not. Do I understand, or do I have a good risk reward view on gold, a good probability assessment going forward? I don't. And if I don't, I just don't take a position. It's as simple as that. I just wanted to show you this chart to show you how severe the drawdown should have been in gold, and it hasn't been.
Yeah, no, it's a great explanation as well. I mean, it comes down to sometimes things don't work exactly the way you think
Yeah.
that they should, and we are in a new market type of environment that we've never been in. You just showed us this chart; it's the fastest ever. I mean, of course, that's not going to be great for gold, and like you said, ultimately, it's still holding up. And there will be. It's just like with anything else. When something's working as a trader, and we're going to go to questions now. Um, we recognize it and we can press it if we have the macro and we have the technical side behind it. And for me, earlier in the year, it was like gold was working really well for some of my ideas. I got a little aggressive, added on something I shouldn't have, turned around. Then I'm like, well, maybe it'll break. Rates are going up. I mean, it's just one of those things where it's just kind of holding there, and it's frustrating you. I think both sides, obviously, shorts and longs. So the stories will still unfold, and maybe at some point it does get clear for all of us. But
Anthony, before we jump to questions, I would like to tell the audience that you guys probably have a gazillion questions, and I will be super happy to answer them all. I have to in 10 minutes, so probably won't be able to do them all today. But you can go and check out my newsletter. It's free. It's called the Macro Compass. If you subscribe and you read my stuff and you put a comment out there, I will always reply to all questions. So let's get them ready now. But I just wanted to tell people you can find that too. If you go there, you can ask me questions in the comments. I'll always reply.
I see people putting in there that if you don't follow his letter, I don't know what to say to you. It's the best, one of the best macro letters out there. I absolutely love it. Highly recommend it. I watch pretty much everything Alf does. So I've got a bunch of questions. They might even be some of the things that we already discussed. I'm going to go back to the people who asked questions earlier, just to show that I did ask them for them. And this is a question I think kind of a trader question. So do you wait until FOMC to trade on a day like today, or you go about it normally and then wait for FOMC?
It's a good question, and I do not like taking risks in a binary outcome situation. As today, it's binary outcome. It's either dovish or it's hawkish. There is no the guy's gonna measure it. How is he gonna measure? I mean, the bond market is asking so many difficult questions, and if he doesn't answer them, that's an answer already. That's already an answer. You can't just So in this situation, I wouldn't take major positions before the Fed unless I have very small probability distribution being different than what's priced in. I would rather wait in general to digest the information, make an assessment, and then I'm going to tell you something. Even in the biggest event that we have seen over the last probably couple of years, planned central bank meeting like today, it is okay if you don't take a position. It's fine. It's okay. It's always a game of probabilities. Just wait for the best setup. Maybe today there is no best setup for your strategy. Tomorrow is another day. It's like playing basketball. If you shoot and make a three-pointer, and then it's not like if you shoot from mid of the field, then that's worth 6 points. It's still 3 points. So it doesn't really matter. One play is one play. Wait for the best setup. Maybe today there is no. We don't know.
Yeah, I mean, I look at it from my perspective as the FOMC days have never been very uh, good for me. It's always like I'm chasing my tail, or I catch one good winner, or I catch one good loser, and it's like great. It's either over for me right away, or I'm just getting chopped up. So I always look at it as, well, why do it? I haven't done anything today, and I may not. The only thing I look at for a day like today is if I think that the market is way overreacting to a lot of the things that you talked about today, and I look at it and it gave me a price I didn't think I would get, then I would look at that as a very small entry, but enough to be able to withstand the shakeout, because they'll probably try that. So Anne Marie, she's been on the show a bunch of time. AMB, how are you? She's asking if we were to use something simple to position like the TLT or such, what would you consider? Now, this is going back to the beginning, talking about some of the stuff that you were discussing.
I'm not sure I get the question. So position with the TLT.
Maybe it was something that was, I think, just relative to what we were talking about at the time. I think she's just talking about the TLT. I've never even actually traded that. What is that? This the 10-year something?
No, TLT is the long end bond ETF in the US. So it captures like 20-year plus bonds in the US. I'm not a bond buyer, and again, we need to see inflation going down, guys, before the Federal Reserve can chill out and before bonds can rally. That's the only thing I'm going to say about bonds. And I've been a bond bull for whatever since I started working, basically, because there were the conditions to be one. But right now, there are no conditions to buy bond. And it doesn't matter how much I love bonds. You should never be married to a narrative. Today, it's not the time to buy bonds. You should just got to be patient.
Yep. This one's from Larry. Any insights on how someone with a short yen position would prepare for Friday BOJ meeting? Would appreciate it.
Another binary outcome, Larry. Tough stuff. And you're short yen. So you're assuming that the BOJ will lean towards breaking the yield curve control mechanism, or anyway selling foreign assets they have. Like they have a lot of US treasuries. They can sell those and they can bring back yen in Japan and make the yen stronger. Or actually, you're short yen. Interesting. Oh, man. It is tough. It's the outcome, and you can be massively right here. You gotta have a view that your subjective probabilities are higher than what's priced in. And if you look at the futures in Japan, like because the yield curve control caps the yields at 10-year. Right now, 10-year Japan is 25 basis points because the Bank of Japan decides so. If you look at futures down the road, so September expiry, December expiry, so swap rates, they're starting to price in some probability that the Bank of Japan has to fold on these stance. So some is already priced in, and you got to have your subjective probabilities being higher than that, Larry, to have confidence. I personally don't have a view, so I don't know.
Yeah. Let's go to the question from John. Just read on Bloomberg that stocks go up by 6 to 10% in the week after a Fed announcement, 2/3 of the time. Good enough for odds for a long position before 2 p.m.? Well, if Bloomberg said it.
I mean, it depends on the time frame. It's like if you look at the last 10 years of FOMC meetings, the whole time the FOMC had to surprise on the dovish side, basically because inflation expectations were too low and they had to accommodate more and the economy has to pick up. So obviously that's a very favorable environment for stocks. But go have a look at the week after the Fed announcements this year and let me know what was the performance. It was not plus 6 to 10%, I can tell you. So exactly. it is not statistically consistent, let's say, or a strong enough argument to go long, I guess. You can be right, but not necessarily because of these statistics.
Because it's based on the environment. You got to put it in context, right? I mean, like you said, Al, look what's happened this year versus the past. You can draw a chart to show that average, but that doesn't mean that is actually true probability. I like this question. Question for Alf. Drunken Miller said, once CPI goes over 5%, then historically inflation has never gone back down until Fed funds go over CPI. Thoughts on that?
That is a very good point. So basically the 5% mark has historically been the mark where inflation had broadened enough. Wages started going up, core services started going up, rents go up. And at that point, it is very difficult for inflation to go down unless central banks go in and become very aggressive. Oh, guys, it's basically what we're seeing now, right? I showed you before, inflationary pressures broadening, terminal rate being priced at 4%. And Druckenmiller is saying when it goes for 5%, then the Fed funds will be up beyond 5%. But hey, back then in the 80s, in the 70s, we also had much younger labor force, we were more productive, we had less debt. So it was easier to bring Fed funds rate up above 5%. Today, Fed funds rate 4% would be quite a thing, given the bad demographics we have, how much debt we have accumulated. In principle, it remains correct that to slow down inflation, once it has broadened enough, you really need to be serious about it. But the bond market is pushing the Fed to be very serious about it. No doubts about that.
Let's see. Well, I'll go to this question. I'm only going to take one or two more because Alf, I want to, before I know we got to run, but I'm going to take this, maybe one more after this, and then that's it. Goes back to Larry. I think you've covered this, but I think this is something, just because I'm going to go to closing comments today. This is something I think a lot of people are probably thinking about. If the Fed does only 50 basis point and the market rips, because we basically talked about this now, because consensus is now 75 basis points and it's almost like a 25% cut in a weird way, right?
Yeah.
Would you sell the rip or start to get in long?
It depends from your time horizon. You can be right in both trades, as always, with the different time horizon. I'm a macro investor with a generally, I have a portfolio, it's on the macro compass, and I have a tactical portfolio that's also on the macro compass. The tactical portfolio has an horizon of 1 month, 3 months, something like that. That's my horizon. So I've been short for basically 4 months now, effectively. With that horizon in mind, if the market would rally because the Federal Reserve surprises a bit on the dovish side, be a good reason for me to re-enter shorts, because you can temporarily try to surprise on the dovish side, but overall, if inflation doesn't slow down, it's going to come to haunt you. You'll have to be more aggressive at the next meeting if inflation doesn't slow down. So things don't really change structurally according to what Powell does today. They change structurally if inflation is slowing down. And then it can really ease things down for a while. That's a different environment. And on top of that, earnings, in my opinion, earnings expectations are too rosy. Analysts are in la-la land. They think earnings growth will be 10% this year and 10% next year. I disagree with that. So I would reload shorts having in mind a 1 month plus horizon, if that is the case.
Well, it goes back to, Alf, everything we talked about today. There's no quick fix to this. And anything, I think, that when you look at reversion back at any of these trends, whether it's crude oil, whether it's equities, there's nothing that supports a trend reversal.
Yeah.
Right. And as much as we put emphasis on what today means and how important it is, there's going to be very little given to us today to support any sort of major trend reversal. And I think that psychologically, so many people are still looking to buy dips in stocks, which is probably why we keep going down as well. It adds to it because everyone feels that they've missed the short. And now they feel like the only way to make money is to buy that low tick and hopefully catch a runner. But that's not an easy thing to do in this environment. Final thing, Alf, because I know you got to go, and I appreciate your time so much. I can't thank you enough. I actually got a lot of comments saying, I'll just put this one out. So this is the best ones you've ever had, Anthony. Alf's prepping questions. There's so much clarity for the common guys and gals like us, and that is the case. That's one of the main reasons why I recommend everyone to follow you. But we're going into FOMC today. Just give us kind of that last kind of, pep talk. Maybe, Alf put the coach hat on, like just what to look, set us into for what expectations are, and just give us a little bit to look at and what they would be outside of that to what you think would trigger any sort of moves in the market.
So the market is pricing in 75 basis point. The market is pricing in a terminal rate at 4% by summer 2023. That basically requires the Fed to do 75 day and 50 basis point at each and every meeting between and 1 year from now. So you can look at what they do today, but also what they promise to do over the next year. That is very important because as Anthony said, that is basically cutting or hiking against expectations. That's very important. There will be also a summary of economic projections being released today, an update from March. So go and look into there as well. What is the Fed What is the Fed expecting inflation to be? What is the Fed expecting unemployment rate to be? What is the Fed expecting the neutral rate to be? Go and look into these nuances. Don't stop at the headline. Try to take some time to analyze what he's saying in the press conference as well. I'll have a thread on Twitter, by the way, and an article tomorrow on the Macro Compass covering in detail the Federal Reserve meeting. So go and check it out if you want. And in general, don't rush into decisions. Look at nuances. Don't be dragged into headlines. don't chase the screen, as my mentor used to say. In these events, nuances are so important. So look at all we have discussed in here, and good luck.
Yeah, everybody, know what you're looking for. I always say, going into any meeting or any sort of big event that's going to happen, know what you're looking for. Don't fly off the seat of your pants and just think that you're just going to try and make something happen. I think what I always look at is those price areas that would force you to get in, that maybe the algos take you there to get in, but also look at what has come out from the statement and the news, and like everything Alf talked about. And careers aren't made today. Most of the time, they're taken away from people. So just know that and understand that. Alf, all I could say is thank you so much, my friend. I can't tell you how much I appreciate it. Everybody, you better follow Macro Alf on Twitter at Macro Alf, and then you can even go to his Twitter page to follow his Substack. I do. I read it all the time. Alf, final thing is just tell everybody the website for the Substack.
Yeah, it's the macrocompass.substack.com. And even if you Google the Macro Compass, you'll find, I guess, it in the first result. And thanks, Anthony, for hosting. It's been a pleasure, and good luck, everybody, with the Federal Reserve meeting.
That's it, everybody. Thank you so much for tuning in. Thank you guys all for the questions. Trade well. We'll see you next week. See you, Alf.
Ciao.
Thank you for listening to Futures Radio Show. If you enjoyed the show, please leave a 5-star review on iTunes. Never miss an episode. Go to anthonycrudele.com and get on our email list for show notifications and for free content that is exclusively for subscribers. Also on anthonycrudele.com, you will find tons of videos and education on trading futures, options, and crypto. Past performance is not indicative of future results. Opinions expressed are solely my own and my guests, and they do not express the views or opinions of my sponsors. Futures Radio Show is produced by Crudele Productions.